Hartalega Holdings' net profit dropped below the 1 billion mark for the first time in 3 straight quarters, in line with the downtrend in earnings witnessed by its peers in the industry. Hartalega's second quarter FY22 net profit contracted 60% quarter-on-quarter to 914 million, as revenue almost halved to 2.01 billion from 3.9 billion in the first quarter of FY22. The glove maker blamed the drop on decreased sales revenue coupled with higher operating costs, as the drop in raw material prices was not in tandem with the drop in the average selling prices of gloves. Exacerbating matters was when its plants were shut down due to the enhanced MCO in July 2021 and subsequently operating with only 60% of its workforce. However, on a year-on-year basis, Hartalega's net profit jumped 68% while revenue rose by 49%. The group declared a single-tier first interim dividend of 35.2 cents per share, bringing its cumulative payout to 54.95 cents per share. As for its half-year report card, net profit for the first half grew fourfold to 3.17 billion, while revenue rose 170% to 5.91 billion ringgit. On prospects, Hartalega anticipates that the one-off special tax or Cukai Makmur announced in Budget 2022 could have a material impact on the group's earnings in the second half of FY22 when it's gazetted. Meanwhile, Hartalega warns that the ASP for gloves has been declining from its peak as supply increases and demand moderates as selling prices drop. Notwithstanding, Hartalega says it will continue to focus on improving efficiency and automation and is optimistic of the longer-term prospects underpinned by growing demand for rubber gloves and expansion plans. Hartalega also says that to support the government's initiative to increase the vaccination rate among the Malaysian workforce, the group says over 90% of its workforce have been fully vaccinated. Nestle Malaysia warned of rising commodity prices in its latest quarterly results announcement, calling it the key challenge it faces ahead. The F&B giant says that the impact will be more pronounced in the coming months and especially in 2022. Nestle saw its net profit for the third quarter grow by 15% to 148 million from a year ago, thanks to improved top line and lower marketing expenses. Revenue grew by 3.6% to 1.44 billion from 1.39 billion a year ago. The group declared an interim dividend of 70 cents per share. Challenges notwithstanding, Nestle remains positive on its prospects in Malaysia, hopeful that the country's economic recovery will progress further and intensify in the coming months. This is couched in the fact that more than 90% of the adult population have been fully inoculated. It also pointed out that its sustainability journey continued to advance in 2021 and will further accelerate in 2022 as it seeks more ways to shape a waste-free future and scale up its planting activities. Carlsberg Brewing Malaysia has confirmed that the prices of some of its drinks will be revised from the middle of this month to account for rising costs. This comes after a leaked letter dated October 14 made the rounds on WhatsApp. Carlsberg confirmed with the edgemarkets.com that the letter is an official communication from the company to its trade partners. The brewer also reiterated the price adjustments are to its trade partner and that it does not determine retail prices, which are set independently by its customers. The letter, signed by the group's sales director Gary Tan, said the new prices for beer and stout would take effect from November 15th. Carlsberg also said that the contents of the letter were meant to be treated with strict confidentiality and that it regrets that the information contained in the document have been circulated publicly in an irresponsible manner. The list in the letter showed that the price of a 24 crate of 320 ml cans of Green Label will be 182 ringgit and 88 cent, while a crate of Asahi will cost 213 ringgit and 36 cent, to name a few. Mr. DIY Group Malaysia says its third quarter net profit fell 20.4% due to higher operating expenses from higher store count, while outlets remained closed during the period of movement restriction. Net profit came in lower at 90.4 million despite revenue improving by 3.8% to 768 million, mainly due to the contribution of new stores. The group has 841 stores currently, up 22% on year. The home improvement retailer also declared a dividend of 0.65 cents per share. there. Mr. DIY says the group also recorded lower income due to the timing of rental concessions and that it expects to receive additional rental concessions in the next few months. On prospects, Mr. DIY says it remains confident of its ability to deliver long-term sustainable growth. This is premised on the underlying strength of its business, strong unit economics of flagship Mr. DIY stores, and the progress it is making on new store growth. NCT Alliance, formerly Grand Flow, says it has been appointed to revive 2 phases of an abandoned project in Batang Kali, Selangor, with an estimated GDV of 500 million ringgit. According to the boss filing, the development involves 168 units of bungalow situated on 80 acres of freehold land. The company said it has been proposed by the liquidator to undertake the scheme proposal to revive the development of phases 2 and 3 of the Genting Valley project. The project was initiated in 2000 and involved 665 bungalow lots but was abandoned by the initial developer in 2004. NCT Alliance EC and Group MD Datuk Sri Yap Ngan Choi says that this first involvement in the Genting Valley project is testament to the confidence in the group's expertise as a specialist in the rehabilitation of abandoned projects. He adds that the group is optimistic of the smooth progress and expects it to contribute positively to its earnings in 2023.